Today on the show, I had the pleasure of speaking with Patrick Geddes. Now, Patrick is the co-founder and former CEO of Aperio Group, a customer indexing firm that managed over $42 billion in public equities by the end of 2020. With a heavy emphasis on tax loss harvesting, a practice that is actually really utilized in my home country of Australia, which I'm sure we're going to get into in a little bit. But Aperio has been one of the very few investment firms in the US to focus on after-tax returns. Formerly, Patrick has been the Research Director and CFO of Morningstar, and he's now the author of the Transparent Investing, his new book, which is called Transparent Investing, which was published in January of 2022. I'm really excited and pumped to have him on the show today to share his incredible insight and knowledge, but enough out of me. Let's get him out here. G'day, Patrick. Welcome to the show. How you doing today, mate?
I'm doing very well. Yourself?
Oh, look, Friday afternoon, can't be better. It's St. Patrick's Day, depending on when you're listening to this, and when I know this will be launched in a couple of weeks' time. But yeah, it is St. Paddy's Day, so looking forward to maybe a cheeky Guinness this afternoon after we knock off work. So
very good.
With that being said, can you rewind the clock and tell me how you made your first ever dollar as a kid?
Believe it or not, as hokey as it sounds, I was a shoe shine boy. My father helped me build a little kit, and I maybe made a couple dollars. It was not a greatly successful venture, but that was my first earned money ever.
Nice. What was your relationship like growing up with money, coming from a shoe shiner?
So my family was not focused on things financial. My parents met in divinity school, of all places. So I didn't have a lot of preconceived notions about it, and in fact, didn't get interested in investing or finance until after I'd finished college. So I was already in my early 20s.
And walk us through the journey. Obviously, I mentioned in the introduction, you've been the head and founder of a big company that's 42 billion. But there's got to be a story before that. There's got to be like a leading down the path of entrepreneurship.
So I worked for a few years after college, and then went and got an MBA in finance. And the thing that really started shifting me was I spent 5 years working as a financial analyst for a big oil company internationally, and then got the job at Morningstar, where I was their first research director. And that was where I first got to apply some of the tools I'd learned at the oil company around after-tax risk-adjusted cash flows, which that's a really common thing to do in the corporate world. Big corporations are famous or infamous, as it were, for that kind of tax optimization. Then when I got over to the investment world, I learned people were basically ignoring it. I was just sort of baffled at that, and then started realizing after I left Morningstar that the industry in the US is very focused on what's going to make it the most revenue, not necessarily what's going to make its clients keep the most money. So how did I become an entrepreneur after leaving Morningstar? It wasn't so much I had that burning drive or knew this was a great money-making opportunity. I kind of stumbled into awfully good fortune. What I did know was I couldn't work at a place where I had to lie as part of the job. And I looked around at the financial services industry, and I love the investment world. It's fascinating, but I realized that would eliminate about 99% of the companies out there. And so if you're going to tell the truth, you unfortunately, in many cases, need to start your own company. And so my co-founder, who is an entrepreneur and did have sort of strategic vision, I didn't have either of those pieces. I had the tech and the number crunching side. So it was a good pair, because either of us alone was worth a heck of a lot less than what we were worth together.
That's awesome. And when did you step away from that company?
That was 1999, and then we were sold in 2021. And I still have a part-time consulting relationship, but I'm not the CEO anymore. I've really stepped away for the most part.
That's great. And so what are you now focused on today? Obviously, we mentioned your new book that's just come out. Are you taking the lessons learned in your incredible history of investing and applying it in the book today for folks to break it down into easy bite-sized pieces for them to consume?
Yes, it's based on my experience with watching how the investment industry sells product. And one of the points I always make is when you hear the concept investment advice, the very first thing you need to think about is what is someone trying to sell me? What are the economic incentives? And unfortunately, the right answer for the vast majority of people is so boring that it's really bad for clickbait if you're in the financial media. It's really bad for sales if you're in the financial services industry. So my focus is now on a kind of crusade to get investors to wake up and smell the coffee that you need to be not cynical, but you need to be really wary in all the investment advice out there, because when you look at the numbers, the efforts to beat the market or time the market are pretty awful. We're all really bad at that. We investment professionals are not good at it, and the vast majority of individuals are really bad at it. So it's kind of a downer message, but it's also very promising in that on average, you're going to make a lot more money with a very boring approach of like buying a bunch of index funds and don't ever trade.
Well, don't they always say it's like if someone had $100,000 and didn't touch it in an index fund for 30 years, you'd be better off than all the human instincts that we make.
You just captured a huge chunk of my book. One of the great my great heroes of investing is not a famous investor, a woman by the name of Grace Groner, who lived to be over 100 years old. She was born in 1909 and died in 2010. As you described, she bought 3 shares of the stock of the company where she was working in, I think it was 1935, and held it for 75 years until she died. And the people, she paid $180, and the people around her actually thought she was impoverished. They would bring her food. That $180 grew to $7.2 million, which she gave to her college just outside of Chicago. So the moral of that story isn't about her research and insights. It's that investing behavior is really what makes you wealthy. But that just sounds so counterintuitive, because there's a presumption that you need to be very smart and quantitatively sophisticated. And I've lived for decades in that quant math, very sophisticated number crunching world, but realized how much of investing is about the psychology. And it's one of those great examples of it's very simple, but it's not easy. Kind of like the analogy I use in the book a lot is the temptation of really unhealthy food makes it incredibly hard for us as humans to eat well. It's not that it's poorly understood. If you eat a diet of entirely, greasy snack foods, chocolate cake, you're not going to live as long as if you eat a lot of broccoli. But our bodies are coded for, did you say broccoli? Forget it. I'm going to take the chocolate cake. And it's the same with investing, that the good stories, the sexy stuff, is all grounded in the excitement of beating out others and beating the market. Whereas this very almost, it's like a Zen thing of don't, breathe deeply, don't try to outperform, and you'll actually be a lot wealthier. That's the irony. It sounds so, kind of new agey or woo-woo, thank you, or theologically high-minded, but it's I find it a fascinating example of how often in life does humility make you a lot richer.
Well, it's interesting, and I don't have any grey hairs yet. Well, I don't think I do, but not as many as
I'm 64, so you got a ways to go.
But you do get the sense that let's boil it down like that. Recessions and things of that nature are driven by humans' decisions.
Yep.
Right. Look at SVB.
Sure.
Right.
Yep.
I don't necessarily know if, and I'm not an economist. I'm not but they made an investment, poor decision.
Yep.
That led on a run on the bank, and now they're where they are. Like we're all just a cumulative. Our choices that we make as investors, as fund managers, all that sort of stuff, will ultimately make or break us, and we hope that we make the right bets. So let's dive a little bit more into that, because sure. I'm really fascinated, because I have the same sort of probably feelings or subconscious feelings that we'll talk ourselves into a recession, or we'll talk ourselves out of a recession, or whatever you want to talk about. So maybe I don't even know where to start here because I'm sure you're the expert. So where would you start?
Yeah, I would start with what the field of research that's now known as behavioral finance, which is basically combining psychology and all of finance, but particularly investing. And the old models from when I was in graduate school decades ago were always presumed what's called the rational actor. And we're not rational actors. We're live, warm-blooded creatures, and emotions aren't a part of us. They are, and we have to incorporate all of those things. So the problem is that we end up making those bad decisions you were talking about because of the biases that are basically a function of evolution. So for me, and there are a bunch of these. There's one called the loss aversion, where people freak out at losing about 2 to 3 times more intensely than the same amount of wins. So like if I'm up 10%, that makes me happy. If I'm down 10%, that makes me seriously miserable. And the same, like up 30 is great. Down 30 is like, I start wondering if I'm going to survive and just go into a panic. And again, this is evolutionary. It's not like our fault. It's what's the fault in our star? It's the fault of our evolutionary origins of our species. The biases that I think are the most interesting and kind of amusing, they're two very closely related ones. One is called the illusion of control, which again, this sounds very woo-woo. Doesn't it sound like a Zen lesson? Where people assume we can control things that are in fact random and out of our control. And you can look at, creation myths from all cultures are about people looking at the natural world and seeing planets moving around in seasons. And naturally, you assume that you do something that affects outcome, like why so many cultures have rituals around the winter solstice, because if the days keep getting shorter and shorter, we're all going to die. And that mindset applies to investing in that it's actually a lot more random than anyone wants to admit. The second bias, you gather, is very closely related, is called overconfidence, where people presume a much, much higher ability in investment skill than we actually have. And that applies to professionals and individuals. In fact, one of the bits of research I particularly enjoy is there's a gender difference on the overconfidence side, that on average, women are slightly better investors than men. And women are terrible at financial forecasting, as are men. So all of us, the reason women are a little better, it's not that they're smarter, it's that they're missing something harmful that we men bring, which is men are much worse at the overconfidence side. So neither men nor women know what's going on, but as men, we presume we do have influence and control. I saw a great little tidbit of research, somebody positing the question, okay, so if you're a man, you should invest like a woman. If you're a woman, you should invest like what? There is a group of people that's better than women. You know who it is? Dead people. A brokerage firm provided some research on all the accounts that had been closed because someone had died and no one was trading or doing anything. There wasn't a trustee or a custodian. Those got the highest returns because no one was presuming they knew how to time. They just sat there and compounded. And that's such a great example of the point in my book, which is it's so counterintuitive, but the data so strongly support this. That's why it's called passive investing, and that's why it bothers people. It just sounds like you're sitting on the sideline.
Dull.
And it's incredibly dull. I mean, it's hard to get people excited about this idea. I've been trying to do this with the book, and it's so boring.
So where do you start then in terms of trying to change? Obviously, you want to look for a good investment industry, or people talk about recession resilience and all this sort of stuff. But what you're trying to say is just time at the wicket. Like I'm using a cricket term for those for those Commonwealthers. But yeah, time at the wicket. That's really just it.
Exactly, and really long time at the wicket where you're not messing with anything. You could view it as when you mess with things, that's when you're going to knock it off and lose. So recessions come and go. The problem is we're bad at forecasting them. What's the joke? economists have predicted 17 out of the last 9 recessions. Like we're trained, we're coded from an evolutionary perspective to see patterns where they simply don't exist. And so where do you start? The key piece is, what's your sort of horizon? And people talk a lot about your risk tolerance. What that really means is, practically speaking, are you going to do something stupid like selling in the middle of in a panic in the middle of a meltdown? And it's not about how smart you are. I've worked with investors who are not the sharpest people you've ever met. There was one person I was advising just ad hoc for free, basically a friend, and found out that she had never sold during the .com meltdown and never sold during the 0809. And she had a great portfolio, and she had terrific risk tolerance, as proven, not that she knew about risk, but that she had never done anything and was basically well schooled in stocks are for the long term. So ironically, it's the behavior, not the clever research and insights. One of the other things that's counterintuitive and shocking about my approach is the amount of time it takes. I'd say you can be an excellent investor and spend an hour and a half every 3 years. Once you get it set up, it can take a little time to figure out who you are. Back to the where do I start? So the first thing you figure out is your time horizon, with the general rule that the longer the horizon, the less likelihood you have of losing money. That's true for very risky assets. And also, can you ride through downturns? And if then you build your what's usually called an asset allocation, just in simple terms for U.S. investors, let's call it, okay, how much you got in stocks and how much you got in safer assets like bonds or cash. And the longer your horizon, typically the higher your stock. So someone rather young might be even as high as 80, 90% stock. That's fine as long as you can ride that through. Like, that can go down 50%. Anyone who says the market just went down 50%, that's not supposed to happen, you shouldn't have been in stocks, because it's going to happen. Not very often, but we've seen it happen twice in the last 25 years. So then once you've picked your asset allocation, which is typically going to be, for someone older and more conservative, might be like 50-50, and very young and aggressive might be as high as, say, 80 stocks or even 90 and a little bit of cash or bonds. And then just buy a few index funds to cover the entire world capital markets, and maybe 1 or 2 bond funds, and you're done. Just don't ever tweak it. I mean, you can rebalance, like, okay, I'm targeting 70-30, and now stocks have gone down so much, I'm at 50-50. Yeah, you need to bring it back, but don't tweak it based on what's going on. That's where you get into trouble. That's where you get into the illusion of control. And that's pretty much it. And that sounds so lame. And the investment industry knows that research of how much better you do with that. But the common refrain for wealth advisors is, well, everybody knows you can't beat index funds, but you can't make any money selling those things, because why do they need me? And that's a little unfair, because individuals do need help on certain financial issues. It's like setting up a portfolio. I just described it. Yeah, it sounds simple, but it can be intimidating. And questions pop up, like I have an inheritance coming. How should I work that into my portfolio? I've got a government pension. How do I there are issues where some expertise can help. The part that so bothers me, though, is this idea of, I want someone who understands financial markets to be managing my money. You're already in trouble, because why? You don't know what's going to happen. Why do you want to pay a lot of money to someone else who also doesn't know what's happening? And that's the research people don't like looking at. It is, as a profession, we're bad at predicting things. Not everybody, but definitely on average, you look at the dollar weights of all the assets for active, we're terrible at it. And yet people still long for that, because it sounds so cool to beat everyone else and to beat the market.
Right. No, I completely agree. And I think we focus on here at RSM Property Group on physical assets of real estate. And we have the pitch to investors. We can control renovations, and those renovations can control how much rent there is, and yada yada yada. You can increase the NOI, so we're in control. It's a physical asset. But yeah, and then that's what we pitch to our passive investors, like, hey, come and invest with us because we know what we're doing, and we tend to know what we're doing, but there's also times where, as investors, we can't always time markets, right? The big thing that we can't control, as much as we can control rents and expenses and hire and fire property managers, the market's going to be the market. And I think that's the tough part, that we all have to put our sort of ego aside. And sometimes you say, yeah, we fucked up, not that we have fucked up, but like, look at SVB, right? They might have just made a bad decision, right?
And real estate is a little different because individual properties may have different characteristics. And I haven't seen the track record for the industry, like for stock investing, that if you're going to buy individual properties, there may be a skill set there. The skill set does not exist. Or sorry, I shouldn't say it doesn't exist. On average, the skill set does not exist for stock picking. So that's the case where instead of picking stocks, individual stocks, you pick all stocks. You invest in world capital. That's why I recommend which index fund, the broadest possible, buy global capitalism. Before this recent meltdown, I think it was at around $95 trillion of value. You can own that in one index fund, and then you're done. That's the part that's so disturbing for the investment industry, is then people aren't going to need to come back, right? And the getting paid for either picking what's going to beat the market or getting paid to try and time the market is not justified by our track record. But the industry does not like people finding out about how bad our track record is. It's very well documented. This is not controversial stuff. I mean, it's controversial in that people aren't happy about it. It's not controversial in that academics all understand this very well.
So as individuals, how do we change our own mindset? And it seems like we're poking fun at woo-wooism. But like being self-aware, right? I think that's exactly that's where it starts. Right?
And this is a growing awareness, because behavioral finance, even as an academic discipline, 25 years ago was dismissed as something woo, and people are winning Nobel Prizes. It's a big deal now. So the behavior question, you could well ask, well, if we're eating too much unhealthy food, what are we supposed to do? That's a hard question. And one thing I would say, one of the things I recommend in the book is, if you're considering hiring a wealth advisor to do your overall asset allocation, your overall financial picture, try and think of the services you need. And there's a valuable service that advisors will tell you they provide, and I don't think they're being dishonest on that one, which is, we help people stay on course and not freak out. And if you are someone who might panic and sell out, then an advisor can actually be worthwhile. In effect, like, protect, keep me from doing myself harm. And you see that in, trainers help improve people's physical attribute. There are programs like Weight Watchers. I understand they use a lot of kind of group support. So think about the psychology first and the analysis second. And if you are someone who's relatively distant, like, for example, if you've never sold and you're old enough to have been in real meltdown markets like the 0809 one, that's a pretty good proof that you don't need that hand-holding. And then you can go to, well, I want them to pick the ones that are going to outperform. That's not warranted. They're not earning their fee. We don't earn our fees on that on average. So it depends who you are in terms of what kind of help you need. I think it's very appropriate to be open to needing help. I'm not saying everyone should do it yourself. That's going too far, but go in with open eyes around the real value wealth advisors can add, but also be very aware of they're not wizards with crystal ball. I mean, they claim to be, but They don't have that skill. One of the analogies I use, in fact, I did a little animated video you can see on my website from The Wizard of Oz, where the iconic scene at the end when our hero Toto pulls back the curtain, right? It's part of now modern American English usage. Pay no attention to the man behind the curtain. And in my little video of it, the advisor is saying, pay no attention to the man behind the curtain. And Dorothy goes over and scolds him. And in the movie, she says, you're a very bad man. And he says, no, I'm not a bad man. And I'm just a bad wizard. And then he actually is very helpful as a kind of counselor or coach, or not quite therapist, but almost to the Scarecrow, Tin Man, and the Cowardly Lion. And similarly, an advisor can actually help as a coach, as an advisory role, as long as the crystal ball bogus thing is not going to come into play. Like, that wizard does not have the ability to look into the future. I know it makes you feel better as a client of mine to think I've got that skill, but I don't. And the data are so clear that we just don't have that skill.
Well, and I think what you're also trying to say is setting expectations on the front end, right? If you're going into something that you're like, I want to flip my money and make $1 quick. Well, you're then you're gonna want to have a crystal ball, or give your money to whoever says they've got the crystal ball. You're going to give it to them. It's about setting the expectation on the front end, because one of the things that I talked a lot about on this show, and it's definitely come up again and again and again, particularly even in the real estate space, the flipping. Historically in the commercial real estate space, people have flipped multifamily in 3 years and doubled people's money. And it's like, wow, look at me, I'm a wizard, to your point. And it's not necessarily the wizard. It's obviously the market is just doing really well, really well. Historically, real estate has been, like stocks, long-term investments, right? And I come from a country where if you double your money in 10 years, you're doing freaking well, right? That's a good average return on investments, where in my world, I've seen people like, well, this is not a high enough IRR. And, I want to double my money in 3 years. Like, well, you're in the wrong sport.
Well, the thing, this is back to the men and women difference. It depends on, I used to actually war game a lot when I was in high school, and they always had victory conditions. And it depends what your victory conditions are, back to your expectations. Let's say you're in a room of 100 people. The overconfidence folks might say winning at the investment game means you look around that room and you aspire to, I want to be number one. Anything else is not going to work. If you want to be number one in that room, let's say for a 10-year holding period, if you want to be number one, indexing is a dumb approach. You're not going to be number one. Some crazy outlier that's going to come through is going to win. Now, you don't know which it's going to be in advance. If your goal is, I want the highest expected return based on the math, I want to have the best retirement, then you go with this indexing approach. So if you define winning as beating everyone else around you, then indexing is not the right play. If you define it as, I want the best chance of the best retirement, whatever you're saving for, next generation, whatever it is, then you go with the indexing. So the expectations management matters a lot, as does that time horizon. So in real estate, I haven't seen data if that flipping mindset gets you in trouble the way it does with stocks. Flipping stocks, the data are very clear that on average people do bad. One of the great statistics I've seen is in 401k plans, they have things called personal choice retirement accounts is one of the names, where you can do your own trading. And I think the numbers are even worse than regular act. It's something like 9 out of 10 players in that game underperform. And it gets even worse when they're very well educated people like engineers, because the overconfidence part kicks in. And someone listening to that who's susceptible to the overconfidence was, yeah, Patrick, I get it. Absolutely. Everything you're saying, I understand completely, but I'm not average.
Right.
And the problem is you can either aim for beating everyone else. The statistic on 15 years returns for mutual funds beating the S&P 500, it's about 85% fail to beat that benchmark. So on a pre-tax basis, you could say, and after tax, it might be 95%. It's just, it's horrifically awful odds if you're a taxable investor and you're trying to beat the market. So in effect, you have a choice of, do you want to be number one, or do you want to take the 90th percentile sure bet that you'll beat all those active managers? And people like the thrill. I want to go for the 10%, even though on average, if you throw in like fees and taxes and you hire a wealth advisor, like over a 30-year period, you'll have less than half as much money as the boring approach. And the data are so clear, but the boring part is so clear too. It's like, well, that's no fun. No, this is not fun. It's about wealth.
And I think it's also about understanding diversification, right? Because you can have parts of your portfolio that gives you the thrills and gives you the scratch, right?
As long as it's small enough.
Correct. You're right. Yeah. You're not going to sink the ship by having firing a few shots over
your play money, your mad money. Yeah.
Right. So I think that comes down to understanding diversification across entire portfolios. Not just I'm heavily focused in real estate, but I don't know anything about the stock market, right? I don't have anything in the stock market, but should I? And from a wealth perspective, from my family, and there's arguments to all of that sort of stuff. And I've always been a very big believer of diversification.
Yep.
And I passively invest with other operators who I think are very, very good operators in the real estate space because I want to diversify away from my own potential stupidity or whatever you want to talk about it. So, but I do think it's also, Patrick, it sounds like it comes down to a lot of self-bloody awareness, right? Go take a couple of meditation classes and start to realize that you're not the biggest thing or you're not the best thing since sliced bread, and understand that we are human and change that mindset. Because when you change that mindset and you approach something from a starting gate that is different to say, I want to get my money double in 2 or 3 years. Then you're probably going to have more likelihood of success to stay the course, which may not sound sexy,
right?
But you then those peaks and troughs start to smooth out.
And you need to be very clear how painful those troughs are. Like I don't claim you can transcend your human emotions. I mean, I get really upset and unhappy in the middle of meltdowns. In fact, I had somebody ask me. I think it was near the very bottom, which was March of 2009. At one point, the U.S. market was down 52%. And a client asked me, have you sold any of your stocks? And I said, no. And he said, oh, so you're disciplined. I said, I'm just as tempted as you are. And I was embarrassed. I confessed, the real reason I didn't sell is because I've been preaching this stuff for so long that the hypocrisy would have been so painful to look in the mirror like, you're just as big a fraud as all these people you're like. That was what kept me in line more than I understand risk, Reed. I'm really on top of this and very no, I'm a human like everybody else. I panic and freak out and get really unhappy. You can't transcend the crushing disappointment of big losses, but you can commit in advance to staying the course. I've heard of a technique, I don't know how widely practiced it is, of write yourself a letter. Dear future Reed, you're in the middle of an incredible, let's call it in your world, an incredible real estate meltdown, like maybe the one in '08. And you're just feeling like your life made me, like this is a disaster. Remember that you knew this was going to come at some point, and that you got into this with this long-term horizon, and you knew there was going to be a price to pay for that long-term horizon, because you get paid by markets, real estate or stock. You get paid for the strength of your stomach lining. Well, it's time to pony up, and you have to pay with this suffering. And I can't make your suffering less. You're going to feel really bad, future me. But please remember not to do anything stupid and just ride through it. And I find that a fun exercise to avoid the kind of, how could this happen? And you see that in the press. Someone after the '08, '09 meltdown, I remember one well-known columnist wrote, well, we all know buy and hold is dead. And I was just laughing. It's like, what are you talking about? No, we're in a really bad time. And there's also something called the recency bias. Emotionally, we're very driven by about the last 6 months. And so the problem is you need to take like a if you're young, like a 70-year time horizon. And that's very counterintuitive. I've read that like geology experts say it's really hard to explain to people the movement of rock and masses when you're dealing with maybe tens of millions of years, because the average human life expectancy is, I don't know what it is now, 75, 80 years globally. It's like, it's not this long thing. And if you've got a geologic perspective, similar, apply that to, I want to flip my money, you're basically signing up for the odds heavily stacked against you, like in a Vegas casino where the odds are stacked against you. Actually, you're a little better off in some Vegas game. I'm not sure what it is. Is it blackjack?
Blackjack.
Is it has some of the best odds. But you're still, your expected return for playing blackjack is something like negative 0.75% or negative 1%. That's pretty close to what active investing. It's like you're going to have a 1, maybe 2% penalty for trying to beat the market, which just sounds so wrong. Wait a minute. By trying to win, I'm going to lose. Yeah, that's that's why it sounds like a Zen lesson. But how many Zen lessons, which might tell you that money is a distraction from real life, and you're too attached to it, and it's unhealthy. This Zen message is you're actually going to be wealthier, and I've got the data to show it.
Yeah, right. I love it. I love it, man. I could continue talking to you for hours on end. But I tell you what, one thing I'll end with is just, we won't die. We won't die not trying. You know what I mean? Like we're all that. And I think the one thing you're missing out here is wisdom, right? You mentioned gray hair earlier, and you've had the ability to have time at the crease, at the wicket, to understand this and look at data and expect. We can all be told it. But it's like, thanks a lot, Patrick. Thanks a lot, Reid. I'm going to go out and try it for myself. And then in 20 years' time, I probably should have listened back. But that's just human nature, as you said. And so I think if you take that factor in and understand that as you're investing, and one thing I do want to make sure we're really key is that education is still super important, right? It doesn't an education around what you're investing in, like investing in real estate or investing in stocks or investing in startups. Like it does matter to an extent if you're taking that part of your portfolio, because education doesn't. If you don't know what a P&L is, go find out what a P&L is, right?
But you don't need a P&L. You don't need to know what a P&L is to invest in the entire stock market and to leave your money there and never sell. So I'm a big fan of understanding better, but the problem is deeper understanding often brings with it that overconfidence. And
true.
What I've seen in the data is people who know nothing about stocks can do very well because of their behavior, their discipline, and the danger,
the ignorance.
It's a healthy ignorance. And back to your point of but you need a little carve out, fun play. And I part of your portfolio. And I actually talked to one advisor who tried to persuade me. I think many investors are better off if you include that, because otherwise you're just telling them to eat a lot of broccoli and they're not going to do it.
Right.
And that's an interesting angle. I was actually fairly persuaded. So.
Yeah. No, that's why it's called a cheat day, where you can go out and have a few beers.
Exactly. Good analogy.
You need it.
You get to eat the chocolate cake. Yeah. Have fun sometimes.
Well, look, Patrick, at the end of every show, I like to dive in the top 5 investing tips. You ready to get into it?
Sure. You may not like my answers.
No. Well, question number 1 is, what is a daily habit you practice to keep on track towards your goals? I have a real gratitude practice of deeply concentrating on how much of my good fortune came from luck and other people, not me. Yeah, I think being grateful every single is really, really important. That's awesome. Question number 2 is, who's been the most influential person in your career to date? In my career, could be in life. I mean, my co-founder of Aperio, just because he had such a different mindset, a fellow named Paul Soley, and it was such a great lesson to learn how much better. That idea of synergy, because without me, he was lame, and without him, I was lame. But man, that was an incredible lesson. Yep. I love it. Question number 3 is, what's the most influential tool in your business? Now, when I say tool, it could be a physical tool, like a journal or a cell phone, or it's a piece of software that you just can't run the business without. What is it?
Well, in the firm we built, we built a factory. I mean, I built the first version of it, and people would be impressed with like the proprietary software, which was fancy, but it was actually plumbing. It wasn't like fancy risk models. So on that, I would say, don't underestimate the importance of boring tools or
model.
techniques or model. I actually just read a great book about the Second World War that said there were some really minor inventions that had incredible impact, and they don't sound sexy, but you don't make movies about them, but
right.
but they can help swing things. So
right.
Simple is not all bad.
Question number 4 is in one sentence. What's been the biggest failure you've incurred in your career? What did you learn from that failure?
I would say the one of the bigger failures was a cybersecurity ignorance on my part, and it was my fault. I was the CEO. I messed up by not investing enough in that. And the lesson was always be wary of your blind spots and use other people to help highlight your blinds, because you're not going to be able to see them. And back to that humility, it's a weird concept of how humility makes you richer, but humility in business is a really valuable skill. You need drive, especially if you're an entrepreneur. You need a lot of passion and optimism to get you to do things, but not optimism in terms of making decisions. So that was a really embarrassing shame. We came through it just fine, but it was a number of years ago. But boy, was it a wake up call on not so much arrogance, but the lack of humility in terms of not listening to dangers out there.
Interesting. Last question. Where can people reach you to continue the conversation? They want to be in your sphere. Where do they go?
So my website, patrickgeddes.co, has a bunch of videos. There's an online version, online class version of the book. You can buy that there, but the book itself is available at bookstores, at online stores. You can get electronic versions for very low cost. That's how to try and join the movement.
Awesome stuff, my friend. Look, I want to thank you so much for jumping on the show today. I just want to reflect some of the things that I took away from today's show. I think, the psychology of investing is so true that we can talk ourselves into anything, both good and bad, and ego plays a massive role in how we control things. And I think it's important to understand that markets will be the markets, right? And you can't control it. Yep. You can't control everything. And sometimes taking that longer approach is the best way. And we talk about time at the crease, but patience. Yep. It's not sexy.
Yep.
It's not going to give you a massive big gold star and make you talk awesome around the water cooler, but it's going to keep you there for the long term. And the data does show. So I really, really timely episode when we're having a bit of a banking crisis right now, and everyone's, the cracks are starting to form. Yep. So I want to thank you again. Did I leave anything out there?
No, that was very well articulated. And that humility doesn't mean things will get better. Like this banking crisis could be a little blip and we've seen the bottom, or we could be just at the beginning of a free fall. Who knows? Right.
Who knows? And that's who knows, because no one has a crystal ball.
Right. And no, that was very well captured.
Well, thank you again so much for coming on today's show. Pleasure. Enjoy the rest of your week, and we'll catch up very soon.
Great. Thanks, Reed.
Well, there you have another cracking episode jam-packed with some incredible advice from Patrick. Please remember to head over to Patrick Geddes, it's Geddes.co to check out...
Geddes.
Geddes. I missed out a D there. My apology. Patrick Geddes, Geddes.co, to check out his book, get your hands on all the information that he has over there and what he is doing. Really, really interesting stuff. I'm definitely going to get my hands on a copy, because it is all about mindset. It's all about us as humans and the psychology around it and how we approach investing. So super, super awesome episode. Again, thank you all again for jumping on today's show to learn about increasing your financial IQ, because that's what we're all about here on this show. The easiest way to give back to the show is to give it a 5-star review on iTunes. And we're going to do this all again next week. So remember, be bold, be brave, and go give life a crack.